Hey everyone, this is Steve with Layman Financials,
And this is Mack with Layman Financials.
and welcome back to Episode 2 of the Mack and Steve Show.
Yes, welcome back.
We had a great last episode, Mac. I'm glad we got together. I'm glad we're doing it again.
Yep, me too.
Well, of course, last episode we were doing under better circumstances. I know we're here for Episode 2, and we had another topic in mind, which was credit cards, but that will be coming. But this week, we will be discussing coronavirus. It's something so big in the news right now that's affecting the markets that we had to have a discussion about it. And I'm glad we can sit down here today and discuss this.
Likewise.
So, of course, this week the market has dropped nearly 8 to 10% on the S&P 500.
I think it's over 10% at this point, isn't it?
Well, actually, as of you are right. You're right. So, the market on Tuesday was around 29,500 at its peak, and currently is at 25,766. If you didn't hear that correctly, on Tuesday, 29,500, and today 25,766. So, in the course of a matter of days, the Dow and the S&P have given up quite a bit of gains, and it's left a lot of investors wondering what they're going to do next. Now, with this type of event occurring in the stock market, some would call it a correction. Some people are saying, well, when is this market going to go back to normal? When is coronavirus going to be eradicated? What are you currently doing, Mac, in this situation? What do you tell a new investor who just got in the market and looking at their financial investments dropping? What do you tell that person? What do you do in this circumstance?
I think what I tell them is to look at the reason that you decided to get into investing, and to realize that you probably didn't decide to start investing for a week or a month or 2 months worth of gains. Likely, you probably started investing thinking about 5, 10, 15, 20 years down the line. Um, and so I think what's important in times like these is just take a step back. And if you can, pull up a chart of the Dow Jones or S&P, the history, and look at what it has done historically. Um, and realize that it's a marathon, it's not a sprint. And there will be times like this. There will be times where we have down markets. The markets do not always only go up. Um, and I think it's important to realize that if you are invested in solid, stable companies, that this too shall pass. Um, so your Microsofts, your Apples, your McDonald's, your Coca-Colas, your Pepsis, they might be hampered in the short term, but none of these companies are likely to go out of business because of coronavirus. So this is a short-term thing. Do not panic. Um, do not sell. If you generally add money on a regular basis and you want to put that on hold, that's fine. But just don't panic. This
Right.
is most likely a temporary thing. Um, Before this, all indicators were that the economy was in good condition. Unemployment was still low. I think the only negative thing some analysts were saying was that the market was a little overvalued, maybe. Um, but long story short, this is a temporary thing, and it's um, nothing to worry yourself to death over.
Yeah, that was the way I like to see it. I like to really hope that the markets can get back to normal. Of course, our thoughts go out to everyone who has been affected by the coronavirus. We know now that it has affected people outside of China. I know Italy has been quite affected with respiratory symptoms. There's people on vacation on cruise ships who've been turned away at their ports of entry, and of course that's hurting the cruise line business, but it's also hurting a lot of other businesses, airlines, entertainment fields. All the businesses are really feeling the hurt, and they're wondering what's going to happen weeks down the line or even months down the line. Japan has already stated that the Summer Olympics, which they spent billions of dollars, it may not happen, or they're wondering if it will happen, and they're saying that that could push them into some kind of recession. So that's just the some economic indicators of what it's causing on a larger scale globally. But we know for the average everyday investor, they're feeling the pain too. But I think some of the information you've given out here is certainly helpful. Of course, the CDC has come out, and they've said that the United States has done a great job trying to contain it up to this point. They're talking about how prepared they are and all that stuff. But until this is over, until it's eradicated, until they find a cure or contain this, obviously the future is kind of up in the air, and that's what investors are acting on right now. I guess the investors are acting on fears, and we see that quite often in the market, don't we?
Yeah, we do. I think the big downturns in my lifetime, the first major one was the 2000 .com crash. Then there was the Great Recession of 2008, 2009. And then we'll get these little micro crashes. I remember back when Brexit was first announced, when it was announced that the UK had actually made the citizens had actually voted in favor of leaving Brexit. I remember the markets dropped significantly, well, the futures at least, and I think that the day after the announcement, the markets dropped significantly. Rebounded, I think, within a week, but it was really based on a lot of fear and uncertainty. A lot of times these things happen, and people are worried about the downstream effects of, how is this news going to affect businesses, um, and thereby affect my investments. And so I think a lot of people right now, um, a lot of people might not even be particularly concerned about the coronavirus, but they are looking to mitigate their losses because, they're expecting a sell-off. They're expecting the panic and fear. So they're selling their holdings, just to mitigate those losses. And there's more than one way to do anything. That style may certainly work for certain people, but I think you run the risk of getting into a habit of making these decisions based off of fear and uncertainty. Um, and just say hypothetically, if you had started selling on Monday, and then just say the markets had gone back up 1,500 points Wednesday and Thursday. Now that's not what happened, but the Dow could hypothetically, it's not going to happen, but just hypothetically, the Dow could go up 2,000 points tomorrow. Purely hypothetical. You just never know, and that ends up being a 2,000 point gain that a lot of people are going to miss out on. And again, that's not going to happen. But I'm just pointing out that when you make your decisions based off fear and uncertainty, um, you do run the risk of missing out on good days, while all because you're trying to avoid bad days.
Yeah, of course. You're absolutely right about that. Um, and as we mentioned before, this has really affected the global economy. We were mentioning on the last video and the Mack and Steve Show episode 1, we were mentioning how a lot of companies now are global entities now. And really the global economy is suffering for this coronavirus and the whole question about uncertainty. The markets do not like uncertainty, which is why sometimes during election periods the market may have a mini crash, or for instance Brexit. You mentioned Brexit when the UK, their political system. There was some questioning what was going to happen. Would they withdraw from the European Union? Would they not? That type of uncertainty, of course, also affects markets. So what we're seeing now on a global scale is how uncertainties can lead to a sell-off. And today alone, the Dow is down 4.5% for the week, down between 9 and 11% for the S&P and the Dow Jones Industrial. But all across the world, actually, stock exchanges are down. For instance, in Germany, the DAX is down 3% today. In Moscow, Russia, they're down 5%. In Italy, Milan, they're down. So that's just a few. And so it really is a feeling that the global economy is feeling the effects of the coronavirus and the uncertainty that comes with it because they don't know how they're going to get rid of it, basically. So right now, investors basically trying to find out what they should do with their money. Some investors are selling. We're seeing that on different message boards online. Investors are asking opinions of others. Should I sell? Should I try to hold on? And we're seeing a lot of people who are just selling, sell-off happening. And that in itself could be causing a lot of this additional decline in the markets. It's just billions of dollars being taken out market. So what would you say at this point? Would you advise someone taking their money out? Would you advise them to cost average down? Would you advise them to try to look for an entrance into something else where they could make a gain? What would you suggest on that level?
Well, my personal strategy doesn't change. I am generally a dollar cost average investor, so I buy a set amount of holdings every week, and that amount generally doesn't change no matter what, whether the market's doing well or poorly. Um, so if that has been your strategy, I would advise not to alter that strategy based on this temporary downturn we're going through. Now, if that hasn't been your strategy, if you do something different, um, then I don't necessarily know that I know how to advise you. But I just know for me personally that my personal strategy generally doesn't get altered much. I pretty much have tunnel vision when it comes to investing, and I try to avoid or just ignore a great deal of the noise that we get coming at us um, regarding market movers or whatever the case may be. Um, One thing I might recommend if you want to mitigate losses is possibly upping your bond holdings. There's certain defensive sectors. I haven't actually checked my M1 account. I haven't actually checked it since um, all this has been going on, but I know certain sectors such as real estate, utilities are generally defensive positions, meaning that if the say the Dow's down 10% right now, utilities, real estate might be down 6 or 7. Again, I don't know. I haven't looked, so I'm not sure. Um, but bond ETFs are good for times like these. Um, if you're into that type of thing, precious metal, gold holdings, they're very big with some people. Um, it's not my personal investing style, but I don't think they're necessarily the worst thing in the world. They do tend to be good during times like this. Now, I haven't looked to see how any of the gold or precious metal ETFs are doing uh, over the course of this week, but I'd be surprised if they haven't held a great deal of their value um, since the downturn, I guess, started last Friday. So those are just a couple of things you can do. You can either just stay the course, continue business as usual as you've been doing, or you can look to get into bonds. Um, you know, Maybe like I said, gold, precious metals if that's what you're into, or you can just Um, just keep doing what you've been doing, and you know it'll just blow over whenever it's ready.
Yeah, I agree with you. You mentioned bonds, and bonds may or may not be a good idea for somebody. It depends on what your uh, retirement horizon is. It depends on your risk tolerance level. I know someone mentioned that if someone had more bonds in their portfolio, then they'd be in a better position right now. And that is some truth to that. But to give an example, for instance, uh, bond holdings right now are pretty much flat. They're up very little right now. Give you an example, Vanguard's ETF BSV, which is a short-term bond, had a return of 12 months of about 4%, give or take. VO, which is the S&P 500, had a one-year return of 31%. So when you tell someone, okay, you can have more bonds in their portfolio to prevent this type of situation now where now you're frantic perhaps, or you're wondering what could I have done to mitigate loss. Um, sure, you can have more bonds, but at the same time, had you been invested in bonds in 2019 as opposed to an S&P 500 index such as VO or Spider, you would have missed out on all those gains. Comparatively, 31% with VO and 4.5% with BSV. Currently, in my M1 finance portfolio, my bond portfolio is relatively flat, almost flat for the week. Flat for the week when you have the Dow down about 10%. In my M1 account, I have corporate bonds, which is your Targets, your Costco. It's basically owning debt from corporations. And then I have short-term government treasury bills, mid-term and long-term treasury bills. And basically that portfolio, that slice is 15%, and it's basically flat. Flat on a week when the market's down 10%. And pretty much besides that, I am almost red across the board. Waste management, which is heavily defensive in nature, also has seen better days as well. So you wonder yourself, why would someone sell waste management on a week like this week? But actually, looking at it, it has been, yeah, it's almost down 9% for the week. So yeah, you really have to look at that as well. Like I said, it's really hard to find a defensive position when the market's already on a downturn. Like someone mentioned, don't try to catch a falling knife as a comparison. But it's difficult to find a place to hide out during this time.
Yeah, you're absolutely right, and it's I don't know, it can be a tricky subject to broach. I'm currently looking at my M1 portfolio, and the sectors that have been the hardest hit have been tech, finance, and energy. Um, Roughly mirroring the market itself. Tech's down 12%, finance is down 11.3%, energy, industrials are down roughly 11%. My most defensive holdings, telecom, utilities, and healthcare. Healthcare kind of makes sense. Telecom is down 6%, utilities is down 6%, healthcare is down 6%. And so the thing is during times like this, people really sell indiscriminately. So, even sectors that probably have very little chance of seeing any disruption, um, they're going to be affected because people are just getting out of everything at times like this. So, Steve is absolutely right when he says that, you can only be so defensive. Pretty much the only thing I have that's really not losing any money right now is my short-term treasury bonds. Even my long-term bonds are losing some money. So I personally haven't upped my bond holdings because of this. But as you just mentioned, Steve, they are flat at a point where, and even actually my short-term bonds, that holding is, let me see, that is the Vanguard short-term corporate bond ETF. and that is up a whopping 0.15% for the week. so, so there you go. At a time when the market's down, as Steve said earlier, between 9 and 11%, my one short-term corporate bond holding is up 0.15%. So really, my strategy is just I really tend to just ignore this stuff. There might be some little things I might do to try to capitalize a little bit off of things that are going on, but mostly I just stick to my strategy. I just continue to buy my weekly allotment of holdings, and I just consider it getting them on sale. One of my biggest regrets from the 2008 2009 market collapse, really one of my biggest financial regrets is that I had neither the knowledge or the capital to take advantage of what were really um, rock bottom prices for some really good companies at that time. Um, so if I had known back then about ETFs and mutual funds and things like that, I definitely would have been loading up on those at that time. And so having the benefit of hindsight, I would really honestly recommend people just load up. Maybe not necessarily all at once because you don't know how long this thing is going to last. But if you're the type that normally buys weekly or bi-weekly or monthly, my advice would be to stay the course and continue doing what you've been doing, and that's what I've been doing, and that's what I plan to do.
Right. Yeah, you're absolutely right. If you ever go into your investment account and you can see how much you've paid for a certain equity and what it's worth on the market. Last week you look at ETF and say, "Wow, this is what I actually paid for it, and this is what it's worth." And last week we were saying, "Well, we're well into the green on certain holdings or most of the holdings." And of course, now you look and you know what you paid for something. And you see things in the red. It's a little discouraging, but at the end of the day, as people say, um, until you sell, nothing's final. So you can ride this thing out. You can, buy down, try to get yourself a better entry point. As long as you don't sell, then you're still in the game. You can still price down. The market can still come back. And like I said, we saw that in 2008. Some people sold out entire portfolios of retirement funds and 401ks, and that was when the Dow was roughly probably around 10,000 or so, right?
Yep.
So here we are, hovering around 26,000 right now. It was 28 last week, I believe. So the market will come back if the market over the course of 100 years has taught us anything. We know the market will come back. And we know things like corrections and uncertainties can definitely cause people to get frightened and things like this from happening. So it's not totally abnormal. So don't be alarmed if you look at your portfolio and see most of things in the red. If you're still in the green on things, then that's great. But if you're a newer investor and you see your portfolio mostly in the red, don't be too alarmed. As long as you've made sound investments with stable blue chip companies, dividend aristocrats, companies that have been around, or ETFs, mutual funds, you'll probably be fine. Of course, we do not know when this will end, but like I said, you have to just be in it for the long term, really.
And I think one thing that's very important to stress at times like these is the importance of having your total financial house in order. So it's important to be out of debt so that you're not looking at, my mortgage payment is going down 10, 15%. I need to take my money out because this is my mortgage payment, or this is money I'm looking to put down on a house in a year or two, or this is money I was saving to purchase a new vehicle or to do XYZ. Um, this is money I was using to, hypothetically pay off a debt I had coming up or something like that. So it's important to have your financial house in order try to the best of your abilities to be out of debt. I know in the first episode, I was talking about how my current investment philosophy came from listening to Dave Ramsey. And Dave Ramsey's big thing is, of course, get out of debt, focus on getting out of debt. And I think because I have no debt other than a mortgage on my home, which is very affordable for me. Um, I'm in a position where downturns like this really don't bother me much at all. I have been almost completely unfazed by this current 10% drop we've had, and who can say how if it were to go on a year or two like we had, God forbid, back in 2008. Who's to say if I would still have nerves of steel like I do now? But currently, this current drop we've had this week really hasn't phased me much at all, and it is because I try to practice sound financial principles of being out of debt, living below my means, um, and so yeah, I think that's very important to reiterate at a time like this, because the more uh, financially stable you are, the better you'll be able to withstand moments like this.
No, you're absolutely right. I'm glad you mentioned about your weekly cost dollar averaging, and it really speaks to um, your intelligence in the market. And if you're able to every single week for 12 months or 24 months or longer, every single week make that contribution to your brokerage account, your Roth IRA, whatever account you have. If you're able to make that weekly investment for years on end, that speaks a lot to your financially, in terms of, as you mentioned, being out of debt, being fiscally, financially responsible, to be able to do that. Because most people we know wouldn't be able to do that. So in this time when the market's kind of chaotic, if you can make those and keep making those weekly investments, no matter what the market's doing, when this all turns around, you'll be in a much better position for it.
Absolutely, and it's literally the only thing that's happening right now is holdings, equities, stocks. They're going on sale. Everybody. Holidays coming. It's Black Friday, and everybody's like, "Oh, discount on this, discount on that. XYZ is going on sale." Um, that's all that's happening right now. Is things are going on sale, and if this would be the if this happens to be the one time in American history that the market doesn't bounce back, then I guess we all have bigger problems to worry about. As Dave Ramsey says sometimes, if that's the case, then you need to be worrying about stocking up on ammunition and things like that. The stock market is going to be the least of our worries if that's the case. So I don't believe it's the case that this coronavirus is going to end capitalism. It's not going to wipe out 50% of the human population. It's not going to wipe out 10% of the human population. It's not going to wipe out 1% of the human population. Um, and not to belittle or to make light of people who have been affected and people who have actually passed from this. And our thoughts and prayers do go out to all of those people. But if you pull up the statistics, we've had tens of thousands of people who have died from the flu already within uh, the last, I guess, probably if you say maybe from September to today or October to today, we've had tens of thousands of people die from the flu. And we don't stop financial and economic progress because of that. Life goes on, and we just keep moving. So I think the thing is with this coronavirus is it's something new. There's a lot of media attention around it, and again, as we mentioned earlier, there's a lot of uncertainty. With the flu, people know that this happens every year and that a lot of people die every year. So we've become accustomed to it. This coronavirus, it's something new. Um, it might be here to stay. It might turn out to be an annual thing. where people get sick, and some people will pass away. But I don't think this is going to long term be something that stops civilization in its tracks. So having said that, I really don't think there's any reason to be worried about your long term uh, investments.
Yeah, no, I agree. And I know how you mentioned right now buying things on discount. So I pulled up a few things here to give our listeners a little idea, if they're not following it already, of what we mean by that. So some individual companies here, the Walt Disney Company, just last week was around $144 a share. And it's currently at 118. Um, so 118 from 144. Carnival Cruise Lines, which has been affected already. There's been multiple news reports that that they couldn't actually dock at their port of entry. And just last week, they're at $44 a share, and now they're at 31. And a lot of others. American Airlines, they were at 30 last week, and they're at 20 now. And these are just three companies that are into the global market, obviously. That just gives you a little tiny bird's eye view of what's going on right now, and what kind of opportunities are out there, honestly. So, me and Mack were talking about last week how a particular ETF that we both like, which is SPHD. It's an ETF, and it's a holding of between 50 and 56 companies. The management, it varies, but between 50 and 56 individual holdings in that ETF by Invesco. It has everything from utilities to energy to healthcare, consumer staples, REITs, real estate. It's pretty diverse. And it was trading around $44 before this happened, and today it dropped to 39. And Mac and I were talking just a few weeks ago how nice it would be to buy back into that ETF around $39 or $40 instead of buying it at 44. Actually, yeah, it's at 38.73 right now. So, here we are now, and here's an opportunity. So, and if you look at it, a fund like SPHD, and say, well, look at these companies. I have good feeling about these companies. I've done my research. These are good companies for A, B, and C reasons. Then you're already bought into why you're buying the stock. Other news and things shouldn't deter you too much, especially now that you're being priced in at even a better price than you had last week. So for me personally, I'm definitely taking advantage of the market downturn. Definitely trying to get my hands on what I can buy and kind of start slowly, because we do not know when this will end. But I think it is a great opportunity for people to get a much better price on things than they would have last week. That's for sure.
Absolutely. Um, and so, like I was saying earlier, and kind of as Steve just alluded to, these are all solid companies, whether they're American companies, whether they are companies from other nations. None of these. It's highly unlikely that any of these companies are going to be run out of business by this coronavirus. So really, this is a great opportunity to get some very good companies at a discount right now. And I personally don't see any reason for me. If you told me that, if we turn on the news and it's like, hey, coronavirus has wiped out 30% of the Chinese population and it's headed for America. And I'm thinking, hey, I might need to get my money together and head for the mountains, or head for the Hawaii or some island, where I can hide out until this blows over. That doesn't seem to be the case. It's currently affected less than 1% of the Chinese population. And I think I read that no children under the age of, I think, nine, no children under the age of 9 have passed away from contracting the virus. You're more likely to be severely affected if you're elderly, and again, this is the case with you know the flu, pneumonia, the common cold. things like this every day can take people out. So I really don't see this as a major threat. So, like I said, I don't see any reason to go and sell everything and go all cash right now.
Yeah, absolutely, absolutely. Well, I think we've made a good point to our listeners that stay the course, um, look at your financials, see where you are, and make a plan for yourself. If you're going to increase your weekly contribution, if you're going to just continue it, and then if you have later on the opportunity to buy in even better, make a better contribution, make a better investment. I know some people are mentioning online that if this continues, they're going to definitely max out their 2020 IRA contribution to get that locked in price. But you just got to look at what you have on the sidelines. You got to look and make sure you're not spending more than you can afford to right now. And like I said, like Mack was saying, we don't know when this is going to end either, so you got to pace yourself. But I think at the end of the day, if you look at history, if you look at other recession type events, obviously this is just what most would call a corrective event. This is not even a bear market. For a bear market to occur, it has to drop 20%, and we have not seen that yet. So at this point, this could be just a minor correction based on what's happening globally. But I think hopefully this message has stopped at least one person from getting on the computer and selling some stock, and I'm sure they'll be regretting it sooner than later.
And I just want to say this is also a good time to reassess your risk tolerance. Do not invest more money. Don't invest money that you need. I kind of alluded to this earlier, but a lot of people pull out because they say this is money I really can't afford to lose
Right.
right now. I can't afford to. I don't have. I'm close to retirement. I don't have 2, 3, 4 years to wait for the market to rebound from this. Or I'm not necessarily in the best financial position right now, and I was just kind of uh, putting my money in the market just because it had been going up so much for so long, and I kind of FOMO'd in and maybe put in a little bit more than I thought maybe I should have. But when the market's just going up, 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 everybody thinks they have a high risk tolerance, and it's not necessarily always the case. So if you can only invest $1,000 a year comfortably, $2,000 a year comfortably, whatever the case may be, it could be $10,000, it could be $100,000, but make sure you stay at your risk level, stay in your lane, and don't try to do too much. Um, if you only had say you only had 1% of your net worth and invest in the markets right now, you're probably less inclined to want to pull out because it's an insignificant amount of money to you. Now, I'm not saying obviously most people are going to have more than 1% of their net worth invested, but my point is that you should not have any more than you're comfortable seeing drop 10, 20, 30, 40, even 50%. You should be comfortable with that. And if you're not comfortable with that, then you do need to reassess your risk tolerance levels.
Absolutely. Absolutely. I agree. And with that message, we'll be signing off here.
Yes, great talking to you again, Steve. It was a good show. Look forward to seeing you again next week.
Absolutely. We'll be seeing you guys next week.
This is Mac G from Layman Financial signing off.
This is Steve T with Layman Financials.
Peace.